Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. Inflation is the biggest worry for the global markets right now, which has led to monetary tightening from the central banks everywhere. It's the key topic on the minds of all investors. Inflation in most countries is breaking all records and reaching historically high levels. Every month, we're seeing data that suggests that inflation is increasing way beyond what anyone predicted a few months or a year ago. So, for an investor, what does it mean when inflation is shattering all past records? Should you stay invested or pull out? Or if you invest, what should you be careful about? In today's video, let's look at what super investors such as Warren Buffett, Charlie Munger, Howard Marks, Seth Klarman, Li Lu have to say about the impact of inflation on investing and what they advise to do in times of high inflation. This will be a multi-part series on investing during inflation. In this part, we'll cover the advice from Warren Buffett and Howard Marks. Before we start, please smash that like button so others can find this video, as well as do subscribe to get the next videos in the series. Let's dive in. First, let's start with Warren Buffett, the investing legend who has been active for the last 70+ years and has seen similar or worse inflationary periods. According to Mr. Buffett, inflation swindles almost everybody. It swindles bondholders, it swindles equity holders, it swindles people who are keeping cash under the mattress. Everyone. Two key pieces of advice from Mr. Buffett on inflation are: first, one of the strongest protections against inflation is sharpening your skills and working to be at the top of your field. This is the best thing you can do at a personal level to beat inflation. Invest in yourself, in developing your skills, because then people are going to give you some of what they produce in exchange for what you deliver. Because skills, unlike currency, are inflation-proof. If you have a skill that's in demand, it will remain in demand no matter what the dollar is worth. Whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. Second, in terms of what assets or investments works best during inflation, according to Mr. Buffett, the best businesses during inflation are the businesses that you buy once and that you don't have to keep making capital investments subsequently. Also, you should avoid any business with heavy capital investment. He highlights real estate as good during inflation, which you may buy once and then also get the rise in value as well. Meanwhile, he calls out businesses like utilities and railroads as not good investments during inflation. Mr. Buffett suggests that companies that tend to withstand an inflationary environment must have two characteristics. One, an ability to increase prices easily, even when the product demand is flat, and two, an ability to increase bottom line with only minor additional investment of capital. Now let's look at what Howard Marks, another investing legend who runs Oak Tree Capital and has spent over 50+ years in the market, suggests about investing during high inflationary periods. Two key pieces of advice from Mr. Marks are: first, according to Mr. Marks, little inflation is good and keeps everything kind of moving. But excessive inflation, defined as much more than 2%, is not desirable. This is because higher inflation means higher interest rates. Higher interest means lower asset prices. And that's what's going on right now. He believes that in this situation, interest rates have to rise. The economy has to be less stimulated. The Fed has signaled it will raise interest rates, which influences borrowing costs from mortgage rate to car loans. He says that these higher borrowing costs will result in a slower recovery. Second, during the times of high inflationary period, according to Mr. Marks, investors should hold more floating debt or instruments with variable interest rates and rent out property with rates that can be raised over time. At the same time, he says that investors shouldn't dump or invert their existing portfolios. I would not throw out everything I own and buy a bunch of what I just described. That's going too far. Just do little changes at the margin, in my opinion. He also warns that timing the market does not always end well for investors, most of whom trade to their own detriment. Being invested over time is what makes people successful as investors, adding that only a few professionals can succeed in getting in or out of good opportunities at the right time. That's it from us for now. Hope you enjoyed listening to the advice from super investors. Please smash that like button and be sure to subscribe to get the next video in this series on investing during inflation. Thanks for watching, and we'll see you in the next video.